is it is designed to build cash value if you take care of it. And sometimes it can build cash value even if you don't. But that's when times are good and the policy works out. What if it doesn't? What if you're projected to get 7% and you get 4%? Did you put enough money in your policy for this thing to last and to create potential cash value options down the road? Did you create enough margin with the help of your financial advisor or agent or whatever that helped you create a buffer in case things didn't go exactly perfectly? Welcome back in, everybody. It is Matt McKay from Safeguard Insurance, and I'm here bringing you part 2 of our IUL series, talking about Index Universal Life, pros, cons, what is it? IUL for dummies, no offense. IUL for kids, IUL tax, and how they're specifically taxed in the scenarios, and also tax-free retirement strategies for high-income earners. And possibly a little bonus. And so just wanted to get into it. This is part 2. Okay, so we're talking about the pros and cons. Last time we talked about what is an IUL in general. Now we're going to get into, okay, obviously it's not for everybody. Nothing in particular is for everybody, despite some of the popular opinions, for example, that you should only buy term and invest the difference no matter what. Or whole life is the only way to go because it's the only policy that's for sure going to pay, and you should get universal life because of this or that. And so we're going to talk about the pros and cons specifically with IULs. So to get started, let's talk about some of the misconceptions and things like that. To back up a little bit, I guess, let's make sure we go over the different kinds of life insurance. There's term, which lasts kind of like it sounds for a certain amount of time, and usually a cheaper premium. Whole life is more expensive, but it's stone cold guaranteed. If you pay the premium, it's going to be there as long as the company exists, which is almost always going to be the case. Or in between those two, between term and whole life, is universal life. Universal life is based on something outside of just paying your premium, but it is permanent life insurance. So kind of getting into the pros and cons of that, obviously a pro is it is permanent insurance, meaning if you purchase this and you live to 105, as long as you've got some cash value in it, it's going to pay the death benefit. It'll also pay the death benefit up front without any kind of waiting period or anything like that. So that's a huge pro, is that it's going to be there for you as long as you take care of it. Now, a con to that is, to the same idea, is that it's not as guaranteed as a whole life, okay? But it is more guaranteed than a term. Now, universal life, like I said, is based on something outside of just, I pay my premium and my policy will last forever. The reason Index Universal Life is cheaper in general than a whole life, it's not always, but in general it's cheaper than a whole life option that you might be able to come across, is because it's based on something besides just paying the premium. The company is passing off some of the risk to something else besides you bringing in your money. Okay? So in an Index Universal Life, it's based on an index of the market of some kind. Now that doesn't mean you're tied into the market. You're actually guaranteed that you won't lose on your cash value portion of your policy in an Index Universal Life, but you'll get some or all the gains of the markets up to a certain percentage, or you'll get what's called a participation rate in some of them, where you get 120% of whatever this one index does and put into your cash value. If it does 0 or less, you get a 0. If it does whatever, you get that percentage. Now, if the policy runs out of cash value, let's say that it doesn't do like it's expected and you haven't overfunded your policy or whatever, it can run down in cash value. And if it gets down to 0, then a lot of times you get a letter in the mail, sometimes without warning. Some companies do send warning messages that something is awry or out of balance. But some of them, you sit there and when you're 73 years old, you get a letter that says, hey, you've been paying $27 a month. Now you owe $300 for this year, and it's going to go up 7 to 10% going forward. So an IUL needs to be taken care of, or a universal life, which we'll talk about universal life a little bit in some of the other videos. IUL and UL are different. A UL is an older concept that has been around since the 80s and 90s, and it was based on interest rates, aka treasury bills. Well, interest rates have been down, so those policies were not written thinking that they would have minimum interest. They generally do now, and usually the interest rate was not very high of a guarantee, usually like 4%, and they were designed to run at 7 to 10%. And so you get into these issues where those policies run out of cash value if they're not overfunded. So back to maybe a pro of an IUL is it is designed to build cash value if you take care of it. And sometimes it can build cash value even if you don't. But that's when times are good and the policy works out. What if it doesn't? What if you're projected to get 7% and you get 4%? Did you put enough money in your policy for this thing to last and to create potential cash value options down the road? Did you create enough margin with the help of your financial advisor or agent or whatever that helped you create a buffer in case things didn't go exactly perfectly? And so when you get an illustration for an IUL, it's going to show your guarantees, meaning even if the market goes down every single year for the rest of your life, this is how long the policy is going to last. And sometimes it'll be 7 years, 17 years, sometimes 27 years. But that's if the market goes down every single year. And this is a point-to-point strategy, meaning, let's say it's to keep it simple, it's in the S&P 500. Okay, everybody pretty much has an idea that the S&P 500 is based on America's top 500 companies in the stock market. Well, the S&P 500, let's say it cuts down 50% one year, which it did in 2008 or so. Well, the next year, or within a couple years, it came back significantly. So that means that every year the stock market would have to stay the same or go down for you not to have one bit of extra gain on that guaranteed side. So guarantee, I like to say, is Armageddon. If the stock market's going down or doesn't exist, at some point we're not going to be worried about the cash value on our life insurance. We're going to be worried about watching out for bombs and trying to figure out how cockroaches live through nuclear attacks, because we want to be the cockroach. Okay? On the illustrations as well, it'll have a midpoint, like say 3 or 4%, maybe 5%, and then it'll have an illustrated point, or what basically the maximum that the government will allow a company to illustrate their funds, because they create a buffer, because if they show perhaps what actually happened, guess what, that can create a sense of false hope, and then it goes down a little bit. Everybody bases their thoughts on the ideal scenario, and then it doesn't work out. And so anyway, you have all these numbers and complications. It can be a bit of a drawback, because if you just want something simple that you never ever have to worry about ever in any scenario, IUL is probably not for you. But then again, IUL can be a lifesaver for someone who perhaps can't afford a whole life premium, for someone perhaps who wants to put extra money back, and possibly create an extra retirement stream that is tax-free. Those are all pros of an IUL, and they're really designed to help boost the cash value. and to give it a little something without having to pay an arm and a leg just to have insurance, and to have whole life or permanent insurance, cash value life insurance, however you want to term it or phrase it. And so it kind of combines the perks of whole life and term together and just puts a little bit of risk on the purchaser. But if you take care of it and do the right thing and you watch it and you have an advisor that you can trust that can help you, that is gold. And these policies can really be impactful into your future and can really provide a diverse option, something that a lot of people don't think about, something that really creates an opportunity for someone, especially if you have some extra funds that you need to put into life insurance, or maybe it mathematically makes sense for you to go with universal life based on health conditions, smoker status, economic, socioeconomic, whatever factors. So pros and cons. I don't want you to get the impression that IULs are the only solution and you better get an IUL now before they run out. We just want to make sure that you know there are pros and cons. This is why you need to go to an advisor that knows what the heck they're doing, that can help put you in the right scenario for you and your family. I appreciate the time. Looking forward to part 3.